Hi, and welcome subscribers to the Saturday Summary for August 2nd of 2014. Of course, your weekly summary of market and economic news for annuity and life insurance professionals. As always, I'm Jonathan Neal, your Brokers Alliance, here for the biz. Well, the month of July 2014 ended badly for the bulls. Our headline, of course, is Don't Cry for July, but it might as well also say Don't Cry for Argentina, as of course they defaulted on their bonds again. You kind of lose track how many times as they go along. But what we saw this week and in the month of July is the broad indices all declining in the heat of midsummer. This past week saw accelerating sell-offs with the S&P 500 losing 2.69%, the Dow down 1.34%, the NASDAQ dropping 1.79%, and the Russell 2000 small cap index losing 2.18% this week. Now, this marked the first time since November of 2011 that the Russell was down 4 weeks in a row. Thursday and Friday were just brutal, with the S&P losing 2.77% between the 2 days. Now, note that both the Russell 2000 and the Dow Jones Industrial Average are not only now negative year to date, but the Russell's rolling one-year gain is only 5.19%, and the Dow's one-year only 5.4%. Now, we're seeing the other broad indices rolling one-year performance declining across the board as well. This was a bad week for European stocks as well, with the EuroStoxx 50 index posting a decline of 2.74% this week. Well, what's putting this train into reverse? Well, it's all the factors we've been discussing in the summary for weeks now, and months really, ranging from record high margin debt and leverage, to geopolitical risk in the Ukraine and the Middle East, to disappointing second quarter earnings in many sectors of the corporate world. Now, of course, a major element putting the brakes on the bull market this week was economic and policy news. On the policy front, the Federal Open Market Committee met this week and announced, as expected, the intent to continue reducing QE stimulus, staying on course to end this stimulus program in October. Well, as all of our subscribers know, this scares large investors who know that one of the three major drivers of this now 6-year bull market has been Fed stimulus. And as we've shown our subscribers often, there is a direct correlation between the rounds of Fed stimulus and the rise of these markets. Big investors know the Fed is getting ready to take the punch bowl away from the party, and this is contributing to what many believe may be the start of a larger sell-off. By the way, most of these graphics like this that we use in the summary are straight out of support materials we at Brokers Alliance provide to our producer clients. Now, on the economic front, this week saw several major things. First, the initial estimate for second quarter U.S. GDP came in at a robust 4%. Now, in normal environments, this would have caused markets to rally, but remember, we're in the era of good news is bad news for Wall Street. Improving economic conditions increase the chances that the Fed will raise interest rates. So again, bad news for Wall Street. Now, the GDP print wasn't really a big deal, though, because no one really believes it, knowing that it'll be revised downward in the coming weeks, as it typically is. Remember, the initial first quarter GDP estimate was about 2%, then ultimately revised downward to a negative 2.1%. Now, in other economic news, the U.S. manufacturing index declined again, and Friday's unemployment report was disappointing in that U.S. unemployment increased slightly to 6.2%. Now, that bit of good news for Wall Street kept Friday's market losses from going deeper than they actually were at midday on Friday. Now, at the end of the trading week, the CNN Fear and Greed Index was at extreme fear, and this is the lowest level I actually recall seeing it. Now, this measurement is run by the folks at CNN Money, and it looks at 7 different market indicators to determine which emotion is driving the market. It's worth taking a look at. The links in the written summary. So, is this the top? Well, no one knows, but it does look like there's cracks in the dam and they're starting to leak. If you're within 5 years of retiring, we urge you to get some of your savings to safety to ensure at least a comfortable lifestyle in retirement. Don't wait until the dam breaks. You may not be able to get out in time. Now, I'll close this week with a quote from an article published at Barron's on December 17th of 2007, as the great financial crisis was starting to unfold. And I quote from that article: "Against this troubling backdrop, it's no wonder investors are worried that the bull market might end in 2008, but Wall Street's top equity strategists are quick to dismiss such fears." Well, that's your Saturday summary for Saturday, August 2nd of 2014. Welcome, August. Have a great weekend. We'll see you next Saturday.